The dollar's strength is influenced by many global factors such as trade, inflation, interest rates, and geopolitics. In this section, we will explore how these factors affect the value of the dollar and its impact on other currencies, especially the lira and the baht. One of the main drivers of the dollar's appreciation in 2022 was the rapid rise of U.S. interest rates. The Federal Reserve, the central bank of the United States, increased its policy rate 4 times in 2022 to fight a historic increase in inflation. Higher interest rates make the dollar more attractive to investors who seek higher returns on their assets. As a result, the demand for the dollar increased and its price rose relative to other currencies. Another factor that boosted the dollar's strength was the energy crisis that hit many parts of the world in 2022. The surge in oil and gas prices improved the terms of trade for the U.S., which is a net exporter of energy. Terms of trade measure the prices of a country's exports relative to its imports. A higher terms of trade means that a country can buy more imports with the same amount of exports, which improves its purchasing power and strengthens its currency. The dollar also benefited from its dominant role in the global economy as a reserve currency and a medium of exchange. The dollar is used by most central banks around the world to hold their foreign exchange reserves and to conduct international trade and financial transactions. The dollar's reliability and liquidity make it a safe haven for investors who seek stability and security in times of uncertainty and volatility. The dollar's role as a weapon also gives it an advantage over other currencies, as the U.S. can use sanctions and other measures to limit access to the dollar for its adversaries. The strength of the dollar has significant implications for other currencies, especially those that are highly dependent on imports or have high levels of dollar-denominated debt. For example, Turkey and Thailand are 2 countries that have been affected by the strong dollar in different ways. Turkey's currency, the lira, has been under severe pressure due to high inflation, political instability, and external imbalances. Turkey imports most of its energy needs and has a large current account deficit, which means that it spends more on imports than it earns from exports. A strong dollar makes imports more expensive for Turkey and worsens its trade balance. Turkey also has a high level of foreign debt, mostly denominated in dollars. A strong dollar increases the cost of servicing this debt and reduces Turkey's ability to repay it. These factors have eroded confidence in the lira and caused it to depreciate sharply against the dollar. Thailand's currency, the baht, has also faced depreciation pressures due to lower tourism revenues, weaker export demand, and capital outflows. Thailand relies heavily on tourism as a source of income and foreign exchange. However, the COVID-19 pandemic and travel restrictions have reduced tourist arrivals and spending in Thailand. Thailand also exports many goods that are priced in dollars, such as electronics, automobiles, and agricultural products. A strong dollar makes these exports less competitive in global markets and lowers Thailand's export earnings. Moreover, Thailand has experienced capital outflows as investors have shifted their funds to higher-yielding assets in the US or other countries. These factors have reduced the demand for the baht and caused it to weaken against the dollar. In summary, the dollar's strength is influenced by many global factors such as trade, inflation, interest rates, and geopolitics. These factors affect the supply and demand for the dollar and its price relative to other currencies. A strong dollar has positive effects for some countries but negative effects for others, depending on their economic structure and financial situation. In particular, countries like Turkey and Thailand that have high import dependency or high dollar debt face challenges from a strong dollar. The dollar is the world's most widely used currency and plays a key role in international trade and finance. The movements of the dollar can have significant effects on the economies of other countries, especially those that are closely linked to the US through trade or financial flows. In this section, we will explore how the lira and the baht are affected by the dollar's movements in terms of exchange rates, trade balances, inflation and economic growth. The lira is the currency of Turkey, a country that has strong economic and political ties with the US. The baht is the currency of Thailand, a country that relies heavily on exports and tourism for its income. Both currencies are influenced by the dollar's fluctuations, but in different ways. The exchange rate is the price of one currency in terms of another. It reflects the relative demand and supply of each currency in the global market. When the dollar appreciates or increases in value against other currencies, it means that it can buy more units of foreign currency. Conversely, when the dollar depreciates or decreases in value against other currencies, it means that it can buy less units of foreign currency. The exchange rate affects the competitiveness of a country's exports and imports. When the dollar appreciates against the lira or the baht, it makes Turkish or Thai goods cheaper for U.S. consumers and U.S. goods more expensive for Turkish or Thai consumers. This can boost Turkey's or Thailand's exports to the U.S. and reduce their imports from the U.S., improving their trade balance. However, it can also hurt their domestic producers who face more competition from cheaper foreign goods. The exchange rate also affects the inflation rate of a country. Inflation is the general increase in the prices of goods and services over time. When the dollar appreciates against the lira or the baht, it lowers the cost of imported goods for Turkey or Thailand, reducing their inflation rate. However, it can also reduce their export revenues and domestic demand, lowering their economic growth. The exchange rate also affects the capital flows between countries. Capital flows are the movements of money for investment or speculation purposes across borders. When the dollar appreciates against the lira or the baht, it makes U.S. assets more attractive for Turkish or Thai investors and Turkish or Thai assets less attractive for U.S. investors. This can increase the net inflow of capital to the U.S. and reduce the net inflow of capital to Turkey or Thailand, affecting their financial markets and interest rates. As we can see, the dollar's movements have complex and varied impacts on the lira and the baht in terms of exchange rates, trade balances, inflation and economic growth. The effects depend on many factors, such as the size and structure of each economy, their trade and financial linkages with the U.S., their monetary and fiscal policies, and their market expectations. Therefore, it is important for policymakers and investors to monitor and understand these effects and adjust accordingly. What are some strategies or policies that can help the lira and the baht cope with the dollar's fluctuations and maintain stability? This is a crucial question for the economies of Turkey and Thailand, which depend heavily on trade and tourism. One strategy is to diversify their export markets and reduce their reliance on the U.S. market. By expanding their trade ties with other regions, such as Europe, Asia, and Africa, they can reduce the impact of the dollar's movements on their export revenues. They can also seek to increase their domestic demand and consumption, which can boost their economic growth and reduce their current account deficits. Another strategy is to strengthen their monetary and fiscal policies and enhance their credibility. By keeping inflation under control, maintaining adequate foreign exchange reserves, and avoiding excessive public debt, they can increase their resilience to external shocks and reduce the risk of currency crises. They can also implement structural reforms to improve their business environment, governance, and competitiveness, which can attract more foreign investment and support their currency. A third strategy is to cooperate with other emerging markets and regional partners to create a more stable and balanced global financial system. By coordinating their exchange rate policies, enhancing their financial regulation, and promoting regional integration, they can reduce the volatility of capital flows and exchange rates. They can also support multilateral initiatives to reform the international monetary system and increase the role of other reserve currencies, such as the euro or the yuan, which can reduce the dominance of the dollar and its spillover effects.